Okay, welcome back to Longevity in the Merciless Market, where we will be discussing different trading strategies across different instruments. And next to join us is Mike Smith, the head of client training and education at Go Markets. Right, he's going to talk about mastering trading exits, a practical approach on how to know how to get out after even before you got into the trade. Mike, please share your screen and take it away. Thank you for your sharing. Mike, you have to unmute yourself and turn on your video camera.
Apologies, V. Yes, I am here. Yeah, just a little bit of a.
Yep, a little bit of system hiccup. We are seeing your Zoom screen, so maybe you want to share just one specific screen, which is your slideshow.
There we go. How's that?
Ah, that's much better. That's good. Excellent.
Great stuff. Okay. All right. Let's get things started. Thank you very much to V and the Track Record team for inviting me along. It's a pleasure and a privilege to be here, as always, and a few familiar faces. And thank you very much for kind invite. Great speakers so far. Really enjoyed the last session. Great work, and more to come, obviously. Now, let's get into it. Really, we're on about exits here. Um, but before I start, I just need to put up this little disclaimer. Just obviously, because I'm representing Go Markets, some of you know that I have other hats on, but today I'm here for Go Markets as the head of client education and trading. And so, as a result of that, this disclaimer suggests that anything that you hear or see, you could do your own due diligence on, um, make sure that you manage risk on every trading action and consistent with your own personal trading objectives and financial situation. Manage risk on every trading action is the key phrase in that, of course, because that's what we're looking at today. So let's start with what is the purpose of exit. The reality is that however we enter, money is won or lost, and the degree to which this is the case on exits. Exit decisions are logically based on risk management, and that's an institutional approach. Um, we There are various ways of making exit decisions, but the ones based on risk are going to be the focus of this particular presentation. And the two risks we're trying to manage, either capital risk or profit risk. When we try to manage capital risk, we're simply asking the question, is there evidence that my original trading idea has gone against me? And then the second question relating to risk we're asking is, how much of my profit am I prepared to give back to the market? And this, of course, assumes that you rarely get out right at the top before something collapses into a heap, or the bottom before something rallies to the upside. As with just about everything I teach, including the discretionary, the hybrid, and the automated trading side of things, market context and structure and price action within that should be your primary foundations for decision makings. And just a note, when we talk about indicators, indicators are not structure, but help to summarize it. I mean, that's an important point that we'll reference later. So let's just review, if you like, our hierarchy of decision making. Now, this is sort of relates to a session I was doing during the week, actually, where I was talking in detail about market context. Um, Understanding market context and structure really should be a foundation of any trading decision. Market context are essentially asking the question, what environment are we in? So we're looking at, for example, trend and volatility regimes. Once we're actually in a trade, we're asking how it's changed. So assuming that our entry is based to some degree on trend and trends on different time frames and particular types of volatility, once we're in a trade, the reasons we're looking for, the reasons that we got in to start to fall down as a reason to get out. That sort of makes sense. If we just quickly uh, pop on maybe to a chart or two, then I just need to change my screen. So if we look at gold, since we've talked a little about it already, here's the gold chart. So any uptrend, and this has been an uptrend obviously for a significant amount of time, is characterized by higher lows and higher highs. So really, it's been an uptrend ever since mid-October on the daily chart after a structural pullback, which found subsequently a support at around about this, just around about 3,900 before it subsequently just moved higher and higher with just small retracements until, of course, we got some major profit taking, a bit of an obliteration last night, a drop of significance. So if we are trading the 30-minute chart, let me actually just the chart to see if I can just talk about gold the whole time. So here's a mistake number one. Okay, so we look at this 30-minute chart. We think, well, hey, US yen's on the way up on this 30-minute chart. And you can see that looking at the 30-minute chart, there's evidence of trend continuation there. That's all great. All we have to do is switch it to the hourly and see, hang on a minute, there might be something else going on here. Because we've fixated on a particular time frame, we've missed the structural resistance at 154. And hence to get in now would be premature. And if we look at the daily chart, we have got a bounce, but again, you can see that structural level there as well. So if you were actually in this trade with the threat now of a probability of around about 30% across the board over the next 3 bars as to which direction it goes next, then if you were in this trade already, been entered on this structural breach at around about 154, 153, 84, then you would be asking the question, is it now the time to get out? So just by looking at a different time frame, the perspective has completely changed. Here you'll be saying, yep, I'm in, I'm continuing to go. Once you even take it to one time frame above, the question is not should I get in, but should I actually get out? And that's an important point in terms of it should be every candle, you should be asking the question, if you're in a trade, should I still be in this trade? And that's shouldn't be based on profit loss, shouldn't be based on anything but the potential risk of what the next move may bring. So with market context and structure go hand in hand, irrespective of whether you're talking entry or exit, and it's got to be a multi-time frame hit. And of course, within that structure, we're looking at key levels and swings and candle structure itself. So how is price reacting within this structure? And does one of these suggest an imminent threat? This is an imminent threat. Because there is a 30% chance or 28% chance of it moving to the downside. Once we're through this, we're in a good place. But why wouldn't you at this stage with this threat here? And a lot of people wouldn't, because they would sort of say, "Oh, let's just see what happens to the next candle. Let's see what just happens to the next candle." So if they'd done that here, let's just see what's happened to the next candle. That would have been the outcome. Does that make sense? So why not take some off or all off here, and then because you've got a strategy that's a breakout strategy, you can get back in here and away you go again, knowing that you've banked or raised significant profit. So market context, market structures, key levels and swings should dictate your execution logic. So if something happens or when something happens, I need to get out, and this is how I'm going to get out. I hope this sort of makes sense. So every exit strategy is based on those key principles. Unfortunately, of course, we've got our own psychology to deal with. Cognitive biases often distort good decision making and exit, even if they're described often in the literature in an entry context. So, in terms of exits, the most common in play are loss aversion. So, what loss aversion does is it says, right, I'm in this trade, I've entered this trade, and it's going against me. But I'll tell you what will just, I don't want to take the loss now. So I'll just move my stop down a little bit. I'll just move my stop down a little bit. Let's move my stop down a little bit until it just becomes too painful to sustain to stay in the trade. And we've seen what would have been a very acceptable and some would call successful loss because you've reduced to your stop turn into one that's significantly more. The other symptom of loss aversion is to have some profit and then just rip it up as soon as profit. It just becomes too scary to leave the profit on the table and see it go on. So every profit, you'll see people take it off, and of course you'll have heard the narrative, oh, you never get broke taking a profit, but that's a guaranteed way to taking profits early to make sure that you rarely sustain any results that are going to be meaningful. FOMO, we've just actually shown you a picture. If we look at this is a FOMO picture in action. This one here, which will happen here. So I'm going to get out here because it might not get through here. That's a sensible way to go through things, or I might take partial off. What FOMO would say is, oh, look, it could go up to this level next or this level next. I don't want to miss out on that. Got to stay in, and then this happens. It's going to happen here. So exactly the same happened here. Here's the key level. Moves its way up to that. Thinks about it, and then drops off. So again, what you've done is you've given away probably all of your profit on this trade, even though it's a drip feed loss rather than all of it. And of course, we say it's okay. We're getting out and we're still in profit. Well, it's not okay because your profit in a trade, and this is really important, write this down. Your net worth in a trade is where it's at right now. Okay, it's not where it was at the start of the trade. Your net worth in that trade and its relationship to your account is where it's at now. So you stay in this trade here, even if you got out at break even here, that's still a loss from where you were. Far, far better to say, right, I'm okay with this because I've got that next strategy to go again if I need to. That sort of makes sense. Recency bias is I've had a recent loss, and this can play into the loss aversion. I've had a recent loss, or every 3 times I've taken I've let it run. I've seen it drop down again, and because you haven't got an active trail, then you see that again, and then therefore what you do is you exit early. Other things to watch, bargaining. So you will say, I'll just give it one more bang. If it just gets back up to this point, then I'll get out. Some of you may be able to resonate with that, or the one more bar syndrome. I'll just leave it one more bar, or one more bar. That looks as though it could be, that looks as though the selling could be fading. And the other thing we often do is ignore change in risk reward profile. I'll show you what I mean. Outside of probability forecasts and stuff like that. Okay. So let's look at the Euro USD. Let's look at the idea of the Euro Aussie. Let's go back to the Euro USD. It's clearer picture. Again, we see a really nice breakthrough structurally, and we see an ideal exit point, which would have been there. Previous swing low structurally. It might get down to there, and it looks as though it will do now. But what we should have done if we adopt the policy that we've just taken about is take it off there. That's the potential exit, and now we're in a state of readiness to go again if it goes down to here. But what I want to talk about is at this stage where you enter a trade, let's say you place the stop at this level. Checking, yeah, I am sharing screen. Oh, what have I done? There we go. Why is it not? Are you guys seeing my screen, my chart screen? I don't know why I'm not seeing that. I've got V coming.
Yes, we are seeing
You
euro
are
dollar.
okay. That's cool. I'm just not seeing it. That's all.
Yeah, yeah.
Um, there we go. Okay. So at the start of a trade here, let's say we're entered here with this stop at this place here. Then our risk. So we've got on that candle there. Our risk is at 35. Our risk is 35 points there, and our potential reward, if we use this level here, is around about 39 points. So it's around about 1-to-1. In fact, let's use this. So 54 points. So 36 to the downside, 54, sorry, 35 risk to the upside because it's a short trade, 56 potential reward to the downside. So at this point here, that profile has completely changed. That profile is now potential reward 16, potential loss 71. Even if you trailed it to over break even, you're still risking around about 40 pips, and to the downside you've only got a potential reward of 13. So now you're at a stage where your potential risk is 3 times your potential reward. The risk profile has changed. So don't forget to take that into your thinking when you're considering exits. And then, of course, part of this is how you view an exit, and this unfortunately comes with time. If you accept that you're not going to win any trade and that losses are a part of trading, then being able to plan those losses and control the degree to which they are a loss is or should be seen as a success if consistency in a system which produces sustainable results, then a planned loss is successful. And that's really a shift of mindset to be able to get to that stage. What I really wanted to talk about in some detail today, in more detail today, is the exit types. So obviously we have our fixed stop loss, usually based on a landmark or an indicator, so previous structural breach. So we break through a resistance level, then we place our stop underneath that, or we might say we're going to do an ATR 1.5 ATR below our entry position. And of course, we use that stop loss to set our position size. Take profits are usually based on market structure. If it's sensible, now one mistake people often make. I need to remove this screen. So one mistake people often make is that let's find one that we might be interested in. Okay, so say we're interested in the Euro Aussie. So what they'll do is they'll say, right, okay, what's the potential risk reward on this if we take a short trade? So we've got a pause here at around about this 169.71 level. Let's say we're interested in trading that. If we're going to trade that, we might put a stop at this level here. And then we'll get to our take profit. So let's just do a green line here. And so what people will do is they'll fudge the figures. So what they'll do is they'll see that and they'll say, there we go, that's our target. Actually, let's move that up a little bit. So look at that. That's about a 5-to-1 risk to reward ratio. So, but that of course is nonsense, because the real potential pause point and potential reversal point is actually all the way up here. Now that changes the risk. That changes the risk to reward ratio greatly. So don't ignore these things just because this one feels good, or even this one. So I've seen it so many times. I'll say to someone during a coaching sessions, right, where would you set your profit target? And they go straight there. Not going to happen. So that's the potential pause point. Now and subsequent reversal. So you've got that risk profile, which is very different to the other. So don't ignore what the chart is telling you, because it feels nice when it fits with your concept of having minimum risk reward. Okay, so other exits include time-based exits, which you tend to use for economic data, or sessional plays, bar-based exits. So you may decide that you're going to exit on X number of bars, whatever the outcome, and then position scaling out, which we'll talk about in a moment. Trading exits are really important. Many people make a bit of a dog's breakfast of it. But there are many, many ways that we can trail exits. So what we're trying to do here is stay in the trade as long as momentum and structure supports it. But we don't want to be too close because we might get chucked out by market noise. So we're going to talk about some of those very, very quickly, but we're including some gimmick in that as a percentage gain of gain. So, for example, one of the exits that we've got on a lot of our EAs is I'm not going to give back more than 30% profit. So it'll log how much profit we have, and then we can use that percentage to guide exit. And then we've got price action exits, which is break of structure, change of context. Pattern exits would be a good example of that. So you're in a trade and you get a double top or a double bottom, for example, is the most common, and then we will get out. Signal flip exit is I would include a fake out as that. So you thought something's going to work, and your trading idea has moved against you. And then you've got performance rule based exits, so equity targets not hit, drawdown exits, exit multiple positions when your account hits. So your target might be, I'm going to make 3% a day or 5% a day, 10% a day, whatever it is for you. So it hits that, and then you just close everything down, go and pour yourself a glass of wine, or indeed a loss threshold has been met. The other thing you may do is, or you should really have, is a maximum trade. So you're going to have open in your account. This helps prevent a little bit of exposure risk, particularly correlated exposure, not just exposure in a single asset, but also if the market turns on a dime and you've got to manage 14 positions, it's a lot more difficult than managing 4. So let's just really, really quickly go through these, because a lot of the exits you may be familiar with. So obviously that if we've got a dynamic signal, such as an indicator, rather than a fixed price, we've got a choice in terms of whether that happens at bar close or on touch. If we put a system stop in MT5, MT4, or just about any platform on the planet, then that essentially is the prices come down and touch that price. We're looking at bar close, which generally tests better than a touch in terms of results, with the exception of one case where you get a catastrophic candle. So there's ways of programming in a catastrophic candle sort of scenario. So with some, and then with some custom indicators, such as a probability one that you saw earlier, thresholds can be used. So, for example, if you're in a long trade and there's less than 25% of it continuing to move up, that may be a sign to it close or partially close. MA cross is probably a MACD cross is probably a really simple one to visualize. Let me just quickly flick to a. If you've not looked at this, it's probably going to want to. Okay, let's find one that might work. Okay, so let's stick an easy MACD on this. Let's actually compare it. So let's say we entered this trade on this trend continuation, okay? And let's say we're moving using just a moving average, a 20 moving average as our trail. Our exit point would be here. If it was on touch, it would be here if it was on close, okay? Let's just make sure you're seeing that. Yes, you are. Right. Okay, so if we just find a MACD to stick on there. Okay, so with a standard MACD, we've got our histogram lines, and then we've got this signal line, which is an MA of the histogram. The histogram is simply a reflection of how far these two moving averages are apart. So let's find another example rather than one we're looking at now. Okay, that's okay. So let's say we entered a short trade here on the basis that now we've got a low that's closed beneath this short-term structural range that it's been in around about 146. Okay, so we enter on this candle here. Now what we're looking for is a way to get out. Now, if we used our 20 MA, we'd actually be out on bar touch at that point there, on bar close at that point there. But if we use the signal line, so what we're looking for is the signal line on a short trade to move below, on a long trade above, and if the signal line, we would be out there. You see how the signal line has moved below the histogram line. So that's our exit there rather than an exit here or here. So if you look at this long trade here, let's say we traded a bounce. There's just a 3-bar that was being talked about before. So we've got a bounce, we've got a 3-bar reversal here. Let's say we got it on there. And we're trading it up, up, up. And the signal line exit would be there. Okay, which is about the same as a 20 EMA. So you're actually no worse off because of that. Let's look at this long trade here. Okay, so we're in on this bar here. Now we trade this to the upside, and we are looking for obviously we're looking for a signal line. I'm just going to put that up. We're looking for a signal line crossing. That's where we get out. We don't wait to see if it's going to breach here. That has now created a level of interest. We've got a fake out there. If we just use the 20 EMA, we'd have been out on this line. We're out on this line. So that's a MACD exit using the signal line. So that makes sense. Captures momentum shifts, great for trend exits. Parabolic SAR reverse, many of you will be familiar with that, and it's a similar sort of position. It's built for dynamic trading. It accelerates in trade strength, decelerates in weakened trend state. You just got to watch this in choppy markets. So again, if I just flick back to a chart. So let's put the parabolic SAR on here. So this is it. So what happens is if you're in a trend state, then the parabolic SAR will flip over if that trend has changed. You see how it gets choppy in markets, but we wouldn't be trading them unless we're trading on a really tight time frame. Let's put on another time frame here. So let's say we entered on this breach of a key level. Structural, again, there's the candle. Candle structure is important. Close in the bottom half for a short trade. Increased volume. Anticipation is there. So, and we can measure that. When you're looking at volume, you shouldn't be just looking at volume per se. You should look at volume versus candle movement. You're looking for efficiency. So you're looking for not only bigger volume, but you're looking for bigger volume with a price move. You're not looking for bigger volume with a bigger price move, not bigger volume with a smaller price move or smaller volume with a big price move. There's an indicator of development which does that. Anyway, we're getting on this candle here. And we can take it all the way down here. Now, it's still under the histogram line. So if we use our previous histogram, signal line, then we're out there. But you can see that's also the parabolic SAI does its business there. If we look here, signal line exit would be this one here. Same on the parabolic SAR. Look here, the parabolic SAR would have actually taken us out here, which is possibly a bar earlier than on the and it works any time frame, of course. So if we looked at the 4-hour chart, let's look here. We've got this. I'm not sure why you would enter that on the 4-hourly. Let's do it here. Let's sort of enter on this candle here. Again, histogram. That one there. That's 1 bar later than the PSR. So that's just another alternative. And if you wanted to trade, actually, what I'll do is I'll just trade let's put the NASDAQ on here. So let's do the NASDAQ. This might sound familiar. Let's do daily and put a 200 moving average on it. Which is actually that red. This is the red line here. That's not very helpful, is it really? So with this, you can either use that through the 200 MA, or you can use maybe a weekly PSR. So you might enter, let's say, so you might enter at this point here, and then you would take a profit there, which is, this is the good thing about having multiple strategies. So you'd rip your 200 points off there, and then you'd have a strategy which trades a breakout. And that's a breakout. You do exactly the same. There's the PSR there, you're out there, and so on and so forth. Then continuation, you'd enter here, and then you'd be out here. So that it's really important. Let me show that again when you can actually see the see it. So here's a 200 MA on this daily chart. So you can enter here, exit here. Then you employ strategy 2, which is your breakout strategy. You enter here, you exit here. And then we've got a trend continuation strategy we can put into play here. We exit here. So you can use single exits for multiple strategies, multiple timeframes. What commonly what happens is something very different. Let's make sure again you can see the right screen. There we go. Is that we can have moving average orientated exits. You're very familiar with those. I just want to talk partial closes. So arguably a powerful and underutilized most traders' exit approaches. Exit rule 1 is partial exit, where the price hits a predefined level of circumstance. So it may be that there's an imminent event. So US jobs data about to be released. You decide to take some off the table because, of course, pre-economic data, you've got 3 choices. You either get out, you either ride it out, or you potentially do something like a partial close or trailer stop tighter. Or it may be that it's getting towards that resistance level and you're quite happy to hold because the underlying market context and market context is still very much in your favor. So what you say is right. It's within X pips of my or X points of that resistance level. I'm going to take 60% off. I'm going to leave 40%. And I'll give it 3 bars. If it doesn't breach it, then I'm out of the rest. So when are you going to do it? How much are you going to do? So the degree of close, and then what you're going to do with the rest. So you'll hear some people talk about, well, look, I'll partially close. And what that does is profit I've taken covers my stop loss, so it becomes a known loose trade. As I said before, it is a loose trade because your net worth in the position is significantly more than if you let it move down to a dollar profit. So what most people do would be to lock some of that in as well. So it may be in this situation, let's do something else. It may be in this situation. Let's find a good chart to do this on. That's 4 hourly. Let's say you entered a 4 hourly 4 hourly position. That's nice. Stick on the daily. Stick on the day. Let's say you trade the bounce off 52.245 on the Nikkei futures contract. At this stage, you're starting to pause a little bit. So you might say, right, let's do some of it. Let's do some of it now. Let's say the original stop was here. So what we might also do is trail that up to a break-even point. So not only have you taken half off here, you've also supported the rest. Is that okay? Just see if. Okay. Is that okay? You're seeing the charts now? Good stuff. Sorry about that. I'm going to go to webinar. Sorry, guys. I'm just negotiating way around using multiple screens on Zoom. Okay, so we get the bounce off here. That's our original stop was here. So at this stage where it looks as though it's starting to falter, we might say let's take 50% off, and then we'll move the rest above our entry point here. So we've locked in a chunk of profit already, but we don't want to lose. We don't want to leave it to go all the way down here and give away all our complete profit. So we'll just only lock some of this profit in, but we'll lock some profit in here as well. So that's a really good way to operate a partial close. Okay, so and then of course you still got to exit that bit. So you're still going to trail. You're going to use a MACD signal line. Are you going to use a parabolic SER dot? Are you going to use just a simple MA and look for price move below it? So if you're writing a partial close plan, those are the four things. Now, then the other way to look at this, and this is for you guys who are already doing this sort of stuff, is to start to think about using context market structure price action to do this. So it's not based on a set price, but you would have to develop an indicator, which then you have an automated exit of some description. There is an exit only that's been developed, and I'll show you something else in a minute that says. Price action is suggesting that probability is that it's done its thing. We can put some easy things on there like etc. We can do there's a volume velocity volatility indicator I've developed, which essentially says this trend is exhausting. So it could be something like that, which dictates when you partially close initially. We've got retracement levels. Remember before I talked about let's just find another chart. I like to just switch charts just so you can see them pulling things out. Let's do Bitcoin. Let's pop it on the 4-hour chart. Oh, actually, no, let's pop on something a bit more exciting. Okay, so let's say we're short this trade on a breach of here. We'd obviously take a profit here. But we might not even get a chance because it would smash through it. So we'd smash through the next structural point. So what we're looking for now is we're looking for retracements of fractal swing lows, swing highs. So this is our original stop here. So what we'll do at this point here, when it's created a new low, we trail it to this new lower high. At this point here, we do exactly the same. Once it's got here, this point here, we do exactly the same. So essentially using retracement levels as a potential trail, which fits with market structure, and eventually it sort of would come and touch this as well. So what this does, it sort of gives room to breathe. It is consistent with structure. And it is really quite easy. It's sort of non-negotiable. I prefer just using standard swing highs and swing lows rather than fractals per se. And again, that's something you could easily use on a 200 moving average strategy. If we just do this. So you use just, if you wanted to trade less, you can do it on a weekly chart. Actually, let's just do a daily chart. So you might get in here, and then you use your retracements on a weekly chart. So there's one. So you'd put your stop here, go back up and trigger that. So if it goes back up and triggers that, you're out, but you're still in here, and now you're looking for the next potential trail point. Let's use another one. Let's look at, so if we're in silver now, say this is our short entry. There's much of a chance really. And let's say initial stop is at this point here. Okay, so there's our swing high, or on this retracement. So that's where we put the trail. We haven't had one there, so it comes down here. We've had a swing high as there. So what we'd do is we'd lock all that in. Okay, so we're using retracement levels to subsequently trail. Okay, thank you. Right, okay, so what I want to do is just show you a couple of things. So the reality is that unlike entries, you are usually with entries using multiple ticks, which have all got to be ticked before you take action. With exits, you're still working with a tick list, but if you're using multiple potential exits, then it's usually any tick results in action. So my stop loss is hit, my take profit's hit, my trail stop is hit, or my time exit is hit. The challenge is the challenge is determining which is the best, approach, and of course, and secondly, how do I actually action that? Because some of those aren't easily actionable. So I'll just show you a couple of things very quickly. So we can do things like this. So we develop MT5, MT4 tools. So a scanner to get in. Okay, so here we have got an exit manager dashboard which created and stuck on MT5. So what this does is it allows us to do a standard stop loss take profit. Also adding a partial close, some give back, and also a time exit if there's some key data coming out. So we can do things like that. This is a useful thing from an exit point of view because what it does, if you stray away from plan or you've got an EA or automated trade, then what it does is you can log in why you've actually done it. So let's say it's this discretionary. Let's say there's a change in market context. I can do that. So you put in the comments. That'll work. I don't select the position there. And then what it'll do is it'll log that, stick it in a CSV file, and then run the script that actually sort of you would run a review every month and see why you're exiting earlier than you should. Anyway, that's that. Seeing the partial. Seeing that. Let me just show you that again. So there's the exit manager. There's the exit logger. And let me show you one other thing, because testing is key. Okay, so here's an EA. This is an EA back test on a Bollinger Band strategy. So it goes in, comes out. And what I want to do with this, let's just do 2022 to 2024. We're testing tower sample 2022, 2024. There we go. Okay, so we're going to run a standard test on this. Now, there's all these inputs here. Talk about those in a second. Okay, what's it doing? What's it doing? What's it doing? It's cooking. Okay, so this is this EA working on oil. I just chose some random dates so you don't think I'm pulling anything out. Too long. Let's just do 2 years. Okay. And all sorts of fresh things in this. Okay, so let's have a look at this chart. So this is not a bad equity curve. But what we can do this is once we've got this, we can, so there's the results from that. Much, much better than that. Let's take out Thursdays for a start. Let's take out Tuesdays. And what we're going to do is we can just then subsequently test a heap of exits. So there's our moving average exit. So we could do true. Make it that. Let's alter our take profit to a 4. Let's alter our stop loss to a 1.5. And what we can do is we can get this to test all of the ones at the same time. So in one hit, we could test at one hit, we could test all the. Let me just run this and I'll see if we've got time to do one more thing. Because this isn't, if you know somebody who can do this, this isn't hard. So what you're doing is you're getting the computer to do the work. So it creates a little EA. You might not choose to trade it, but you might use it to test exits. So if you reduce the number of trades, because we took out Tuesday and Mondays, or Tuesdays and Thursdays, is it any better? It's not really. Okay. Okay, so that's even worse. Let's just go back to where we were before. Let's find one that's a little more exciting. Actually, no. So what we can do, let me just show you a multiple test because the results aren't that important. But we are doing a session on EAs at some stage soon. Okay, so I can test different stops. I'll test from a half in half ATR increments, and I could test profit target up to 6. I'm just going to do this. If I use all of these exits, it's going to take too long. But it'll give you the concept. I'll put Mondays back on. Okay. So if I start this, what it's doing is it's testing all of those variations for me. Okay. It's going to be too slow, I think. Let's not regime off. Okay, that's possibly. I will come back to that in a second. Okay, so your actions really review the material covered today. I hope it's been useful. The key thing is to try something different. Use the approach that I might be using this exit now, but I will try this next exit in comparison. So yeah, you got my Go Markets email is there. Some of you have got the Trader IQ one as well. So if you're interested in any of the tools and stuff, then you can ping me that. But Go Markets have got a multitude of products that you can trade, and great service, great education. Right, just to show you very, very quickly is the last thing. This is the power of testing. So with just testing those variables, I now know over that time period which is the best stop loss and which is the best take profit, which appears to be two for the stop loss and take profit. So we run up a full back test, and now that's looking a little better, isn't it? And then we can keep on doing that with the other entries. We'll probably take out Thursday still, but it's not. Um, And as I said, the other option is an exit only EA, which you enter. So if you don't want to exit while you're asleep, you can put all these exits I've been talking about. There we go. So slightly getting better and better as we go. So that's me done, I think, for time. I hope that's given you some things to work on, some things to have a look at. That's, I think, me done. Apologies for the slight sort of delays in flicking charts on and off. Hope you managed to get something from that. And forgive me for for the slight delay in doing that. So thank you very much, everybody.
Thank you, Mike. We have one question. Just
Sure.
about. Do you re-enter a trade at a higher price that you recently exited based on your exit point due to profits?
Absolutely. So if there's a resistance there, there's essentially it's called resistance for a reason. There's three things that can happen. It can pause there, it can bounce to the downside, or it can break through. As often as not, it'll do. So you've got a 30% chance of it breaking through. So why not rip it off? And you've got a breakout strategy. I'm sure most people have. So get ready to go again. The alternative would be, as I was saying, maybe utilize a partial close or take off X% of the trade. And if it fails to reach or starts to pull down, just close the rest. But then be ready to go again. And it is the advantage of having multiple entry setups within your trading plan, so you can take advantage of that, and it removes the fear of missing out. Because if you know that if it breaks the resistance, you're ready to go again, then that removes a fear of missing a further up move, which is, of course, the reason why people stay in when they shouldn't. I hope that sort of answers the
Yep.
question.
So yeah, so you must really have a good re-entry strategy to remove
Absolutely,
fear of missing out, right? I think people don't exit
absolutely.
because they are always fear
I
FOMO, right? Like
completely
I can't
agree.
get out of here, right? Yeah. And I
Completely agree.
think also many people don't they tend to take profits too early and because they don't have a sound exit strategy which has a re-entry strategy that are connected with it, right? So they just get out and then they just watch for a lower price to get back in. They always
Yeah.
psychologically remember the lower price to get it in, and then uh,
Yes, indeed,
yeah.
indeed. You're
So
so right, V.
I have friends who are like really good traders, but they exited silver at 60 and watch it go at 120. But who knows? Maybe by Monday it's considered a good exit, right?
Maybe, maybe.
Yeah, maybe
After
Monday
what
8
happened
a.m.
yesterday.
Monday
Yes.
8 a.m. Melbourne is a good exit because it's at $30. Okay, anyway, thank you very
Thank
much
you very
for
much.
your sharing, Mike. I think it was very comprehensive, not many questions which you didn't answer. And that's all the time we have anyway. For those of you with questions that we did not answer, please feel free to email Try Record or Mike himself uh, to be kept informed as well of what he's gonna what kind of training he has. Okay, cool.
Thank you
With
very
that,
much, V.
we are most welcome,
And
sir. With
thank you,
that, we are
everybody.
going
Enjoy
to.
the rest of the day.
Yep, thank you. Thank you for spending your Saturday morning, Saturday afternoon with us for an hour. For the next session starts in 5 minutes, so we'll have a little bit of a break to get a tea and walk around. We will have Adrian talking to us about the systematic trading and how to end the struggle that most traders have. He is Adrian Reid, founder of Enlightened Stock Trading. So he'll tell you about his systems and how to build a system that is sound and will help you end the struggle that most traders face. That's at 11:30 Singapore time and 2:30 Melbourne time. All right, see you in 5.